Welcome to the Deep Dive. Thanks for sending over the stack of sources, filings, news, research notes. We're ready to dive in. Our mission today, a rapid but really forensic look at the last 24 hours in the markets. We're focusing on the key signals across fintech, health tech, real estate, and media, all curated just for you.
That's right. It's that time when earnings reports, strategic news, it all hits at once, creates a lot of noise. We're cutting through that, focusing strictly on the material events from, well, basically the period around November 5th, KST. This window catches those big Q3 releases, some bold strategic moves, investor actions, stuff that often dictates where things head next. And we're really trying to get at the why behind the headlines, especially where the data looks contradictory or just plain surprising.
Okay, let's unpack this then. We have to start where the data is, frankly, the most confusing. That's the lending sector. We've got what you call the upstart paradox, ticker UPST. They announced Q3 earnings November 4th, and yeah, need some serious decryption.
It really does. It's a classic case of conflicting narratives coming out of the accounting. So if we start with the top line revenue, Upstart recorded $277 million. Now, that was actually a miss, albeit a small one, against the market consensus. Analysts were looking for about $279.59 million. In fintech, even a slight miss like that, it raises eyebrows, especially around revenue growth.
But the real puzzle, the part that makes you stop and really analyze, is the earnings per share. The EPS, like you said, we saw reports coming out at basically the same time, showing two radically different figures.
The difference is pretty staggering, and it puts immediate pressure on the stock, right? So report A said EPS was $0.52, positive 52 cents. If that was the whole story, you'd say, wow, great beat. The estimate was $0.42. Beating by 10 cents, that suggests really strong profitability, good operational control.
But then, report B comes out. Same company, same quarter. And it says EPS was negative 6 cents, a loss. So that misses the $1.42 estimate by, what, almost half a dollar. How can one company in one quarter deliver both a solid beat and a significant miss on the bottom line? It doesn't seem possible.
Well, the entire explanation is in the accounting method. It boils down to GAAP versus non-GAAP. GAAP is the generally accepted accounting principles, the standard stuff. The negative 6 cents, almost certainly the GAAP number. It's strict, unadjusted, includes all the costs the formal rules say you have to include. Crucially, things management often likes to exclude when they talk about how the core business is doing.
Okay, so non-GAAP is the adjusted figure, the $1.52. What gets excluded to make that kind of jump from a loss to a solid gain?
Well, in a tech company like Upstart, especially one growing fast in lending, these adjustments can be really significant. You're typically talking about non-cash charges, like stock-based compensation, SBC, that can be huge for talent. Also, big marketing expenses may be framed as long-term investments. And for a lender, this is key. Changes in reserves for loan losses or impairment charges if they hold loans on their books, things like that. So management uses that non-GAAP number, the positive $1.52, to basically tell a story. Look, ignore these temporary or non-cash items. Our underlying engine is really profitable.
I see. But that puts you, the listener, the investor, in a tough spot, right?
Yeah.
Which number matters more? Do you buy into management's growth story based on that adjusted non-GAAP beat? Or do you focus on the GAAP loss, which suggests the actual cost of running the business, paying people, managing loan risk? It still outweighs the revenue.
Exactly. It's not just accounting trivia. It's a fundamental clash of narratives. Often, the market might react positively short-term to the non-GAAP beat, momentum. But that gap loss, it hangs there. It's like an anchor signaling potential structural risks, long-term profitability questions. It makes you ask, okay, when can this business actually make money under the standard rules? Is the foundation really solid?
And adding weight to that skepticism, Upstart also gave its full year 2025 revenue guidance, $1.04 billion. That fell short of what analysts expected, which was $1.06 billion. So you've got a revenue miss, these really confusing EPS reports, and now lower guidance for the year ahead. That's a tough combination.
It is. It suggests that even if they can manage the profitability picture using adjustments, the core engine revenue growth might be sputtering a bit. And for a company valued like a growth stock, any sign of revenue slowing down, especially when interest rates are high, is a major headwind. Investors want to see not just growth, but quality growth and clarity on the risks. The market's likely reaction tells you they're probably pretty skeptical about the path forward right now.
Okay, let's pivot from that complexity to a company showing some strategic agility, trying to navigate these same sector concerns. Let's talk SoFi, ticker SOFI.
Right. So AFI seems to be actively working to diversify away from just the lending risks that are maybe tripping up Start a bit. Their big news came out about 8 hours before we compiled this data is a new partnership with United Airlines.
Yeah, I saw that. And it's not just another co-branded credit card, which we see all the time. The detail here seems important. It's a new Mileage Plus debit rewards card. Debit, not credit. Why is that distinction so significant strategically?
Oh, it's huge. This is a really smart play on two fronts. Customer acquisition cost hack and strengthening their balance sheet. Think about it. Digital banks, neobanks, they spend a fortune on marketing to get people to open accounts and deposit money. It's incredibly competitive. By partnering with United, SoFi gets almost instant access to millions of Mileage Plus members. That's a large, engaged, often financially savvy group.
So they're essentially acquiring potential banking customers without pouring money into, say, social media ads or search keywords.
Precisely. It dramatically lowers their SAC for this group. In the debit card part, that's about gathering deposits. Deposits are the absolute lifeblood for any bank, digital or traditional. They represent the cheapest source of funding, the lowest cost of capital, or COSI. Every dollar someone deposits into a SoFi account linked to this United debit card is a dollar COFI. SoFi doesn't have to borrow at higher rates on the wholesale markets. It helps shift the perception of SoFi. Less like a high-growth, maybe riskier digital lender, and more towards a stable, full-service digital bank. One focused on sticky customer relationships, gathering those low-cost deposits. It directly addresses that core risk concern facing fintechs right now.
Makes sense. Before we leave fintech, just a quick status check. We looked at Block, SacAQ, Affirm, AFRM, PayPal, PYPL, Robinhood, H2, Coinbase, COIN. Pretty quiet in this media 24-hour window.
Yeah, seems like investors in those names are probably just digesting everything else that's happened recently, the broader macro picture. But one key thing for you to watch, Linden Club, LC, they're holding an investor day today, November 5th.
Ah, okay. And investor days can be significant.
Definitely. They're designed for management to lay out the strategy in detail. Often you get new long-term targets, maybe even news about a strategic shift. Given the current rate environment and the pressures we just discussed with Upstart, the market will be listening very closely to what LC says about their own loan performance, credit quality outlook, maybe how they plan to fund loans going forward. When the other big players are quiet, sometimes it means they're waiting to see how a peer, especially one holding a dedicated event like this, frames the narrative for the coming quarters.
Right. The calm before potential strategic news from LC. Okay, let's move on. From the intricacies of fintech data to the strategic battles playing out in health technology, this space is fascinating right now, especially around virtual care and the just massive market for GLP-1 weight loss drugs.
Absolutely. And we start with LifeMD, ticker LFMD. They made what looks like a very calculated strategic move, designed to sharpen their focus, get some capital.
Right. They completed a big transaction on November 4th, sold off an 80% controlling stake in a subsidiary, WorkSimpli Software LLC. That sounds like a major divestiture.
It is. And the terms highlight the immediate goal, cash. Total deal value is around $65 million. LFMD got $22 million in cash right away at closing. Plus, there's potential for up to $28 million more over the next 3 years, but that depends on WorkSimpli hitting performance targets. Those are earnouts.
Okay, $22 million cash up front is significant. But why sell off what sounds like a software asset? Was it underperforming, or is this more about strategy?
It seems much more strategic than a fire sale. Think about focus. WorkSimpli was, from what we understand, more of a legacy software business. It wasn't really core to LFMD's main mission, which is virtual primary care and pharmacy services. So management is effectively telling the market, we're taking this non-core asset, maybe it wasn't scaling the way we wanted, and turning it into cash we can deploy in our main business. They're doubling down on virtual care, which is where they see the high growth, the better margins. In a space as competitive as health tech, you really can't afford to divert resources or management attention to things outside that core vision.
And getting that $22 million cash right now is interesting timing, isn't it? Because LifeMD is set to report their Q3 earnings on November 6th.
Exactly. It gives them flexibility right before they face investors. That cash could go towards, R&D, maybe scaling up their pharmacy operations faster, bolstering marketing. It provides options. It also sends a clear signal. We are committed to virtual health. Now, contrast that move focusing, raising cash with Hims&Hers, ticker Hims. They're showing real aggression and executing within that same virtual care space.
Yeah, Hims reporting Q3 just slightly outside our 24-hour window back on November 3rd. But the strategic direction coming out of that report is absolutely driving how the market sees them right now.
Definitely. The key metrics showed just explosive demand in their weight loss segment. They said they're on track to blow past that $725 million target they set for weight loss earlier in the year. The demand for GLP-1s, whether it's the branded stuff or compounded versions, is just off the charts.
And it sounds like they're not just riding that wave. They're actively pivoting their whole strategy around it, moving away from just the sort of on-demand sexual wellness stuff that built the company.
That's a key shift. They're moving towards what they call personalized daily treatments. Think about what that means for the business model. Daily treatments imply subscriptions, higher customer stickiness, a much more predictable recurring revenue stream, higher lifetime value, LTV. They're trying to evolve from being seen as maybe a transactional, one-off purchase company to more of an embedded, ongoing health management platform. The market tends to reward that shift with higher valuation multiples.
And the most dramatic lever they're pulling seems to be on price, specifically for GLP-1s. They're cutting prices on their compounded GLP-1 therapies by up to 20%. That sounds aggressive.
It is incredibly aggressive and very calculated. Compounded GLP-1s are basically non-branded alternatives to drugs like Ozempic or Wegovy, made by specialty pharmacies. By slashing the price, Hims is making a massive play for market share. They're targeting people who want the weight loss benefits but maybe can't afford or access the expensive branded drugs. They're betting they can make up for the lower price per prescription with sheer volume. It's a land grab strategy.
But doesn't that risk margin significantly, cutting prices by 20%? I mean, could that spark a price war with other telehealth platforms or compounding pharmacies? Is Hims ready for that kind of margin pressure long term?
That is absolutely the core risk, and we saw the immediate effect. Their Q3 gross margins actually declined sequentially. The reports attributed that directly to, quote, reduced revenue per shipment in some weight loss products. So the price cut is biting already. Management is making a bet here, a big one. They believe the sheer volume of new subscribers they attract, the stickiness of that subscription model, the potentially higher LTV over time, they think that will eventually outweigh the short-term margin pain. They seem to be optimizing for market dominance first, margin perfection second.
And their longer-term actions seem to back that up. Expanding facilities, talking to the big pharma players.
Right. They mentioned expanding facilities to handle the expected surge in volume, and critically, they're apparently in talks with Novo Nordisk. The goal: to potentially offer the branded oral version of Wegovy on their platform when it becomes available. Getting that Novo Nordisk deal would be huge. It adds legitimacy. It gives them a path to transition patients from the lower-cost compounded version to the patented drug if needed, maybe for insurance reasons or preference. It hedges against regulatory risks around compounding, too.
And looks like big institutions are buying into this strategy despite the margin concerns. A Schedule 13G filing showed JP Chase holds an 8.1% stake in Hims.
Yeah, that's a significant vote of confidence from a major player. It suggests sophisticated investors see the long-term potential in this high-volume, market share-focused strategy, even with the near-term margin pressure.
Okay, and just to round out health tech, quick check. Teladoc, tdoc, amwl, amwl, Doximity, DOCS. Relatively quiet in our window. DOCS has earnings coming up on November 6th, though.
Correct. The main action, the main strategic narrative right now is definitely around LFMD's focus move and Hims' aggressive push in weight loss.
All right, let's shift again to real estate and home goods. And this sector seems really split right now. We've got one tech player absolutely crushing it, while other parts are still feeling the heat from interest rates.
Exactly. Starting with Compass, ticker COMP, the residential real estate tech company, they reported Q3 earnings, and it was a clear beat, really validating their model and what's still a pretty tough housing market overall.
The numbers are kind of startling, actually, given the backdrop. Revenue was $1.85 billion. That's up 23.6% year over year. And the number of transactions they handled, nearly 68,000 deals. Up 21.5% compared to last year.
Yeah, and you absolutely have to put that 21.5% transaction growth in context for the listener. During that same Q3 period, the overall U.S. residential real estate market, transaction volume grew only about 2.0%, flat, basically. So Compass is growing its deal volume more than 10 times faster than the market itself.
Wow. Okay, that's just massive market share capture then. How are they doing that? When high rates are supposedly freezing transaction volumes for most brokers. Is it all about their technology platform for agents?
It's likely a mix, but the tech platform is definitely core to their pitch. Compass offers agents a pretty slick software suite for leads, marketing, closing deals. The argument is it makes agents more productive, but there's another factor. They're also known for being quite aggressive in recruiting top-producing agents from competitors, often by offering very attractive commission splits. So it's partly empowering agents with tech and partly consolidating market share by attracting the best talent, even if it costs more upfront.
But does that strategy, paying top dollar for agents while building tech, does that come at a cost to profitability? Can they sustain that if they always have to offer better splits?
That's the million-dollar question long-term, for sure. But for now, the financials are showing improvement in operating leverage. Adjusted EBITDA hit $93.6 million in Q3. That's a big jump from $52 million in Q3 last year. So as volume grows, they are getting more profitable on that adjusted basis. Now remember, adjusted EBITDA for a company like Compass still excludes some major costs, especially non-cash ones like stock-based compensation, which is significant when you're recruiting heavily. Their GAAP net loss was still $4.6 million, but the trend in adjusted profit is positive.
And management clearly expects that momentum to continue. Their Q4 guidance anticipates revenue between $1.59 billion and $1.69 million. They seem confident the platform keeps winning.
Seems that way. Now shifting from real estate deals to the stuff people put in their houses, home goods, the big story for Wayfair, ticker W, wasn't really about their own operations in the last 24 hours. It was about Wall Street sentiment changing.
Right, driven by that big analyst upgrade. Citi took Wayfair from neutral up to buy on November 4th. And they hiked the price target significantly, up to $65.
Exactly. And that kind of upgrade from a major firm like Citi is powerful. It signals that institutional confidence might be returning, which is notable given how volatile Wayfair stock has been. The reasoning Citi gave is key here. They cited growing confidence in Wayfair's ability to improve its profit margins and signs that consumer demand in their category is starting to stabilize.
So the narrative is that all the tough cost-cutting Wayfair did the layoffs, the supply chain work, getting more efficient, actually starting to work, leading to better profitability per order.
That seems to be Citi's take. Wayfair's own Q3 earnings report recently was actually a bit mixed, some good, some bad, but their guidance for Q4 was positive. It looks like Citi believes Wayfair has weathered the worst of the post-pandemic slump and the macro pressures and is now better positioned to capture demand as things maybe level off. And the market reacted strongly. Wayfair was one of the top performers in the S&P 500 on November 4th, purely on the back of that upgrade. Shows you the power of analyst ratings.
Okay, let's quickly touch on the more luxury and lifestyle niche within home goods, starting with RH. Restoration Hardware.
Right. RH filed an 8K. It was about the official opening of their RH guest house and spa Napa Valley on November 4th. This isn't just retail news. It confirms their ongoing big strategy. Expand beyond selling furniture into luxury hospitality, creating this whole lifestyle ecosystem. They want to be the luxury brand experience.
But opening fancy guest houses and spas, that sounds incredibly expensive. And it's happening right when their target customer, the high-end consumer, is supposedly feeling squeezed by interest rates and economic uncertainty. Is the timing maybe a bit off? Prioritizing brand over near-term financials?
That's precisely the debate among investors. Strategically, it's ambitious, maybe even brilliant for long-term brand building. It elevates RH beyond just being a store. But you're right, those big-ticket discretionary items, the $30,000 sofas, those are often the first things people postpone when rates are high or they feel less wealthy. So the analysis suggests investors are kind of waiting. They see the vision, but they want more concrete proof that the high-end consumer is really ready to start spending freely again before they fully reward RH for these very capital-intensive projects. It's ambition versus timing.
Okay. And then there's the Lovesac company, ticker LEE. They seem to be facing some sentiment headwinds. Stock underperformed the market on November 4th.
Yeah, relative weakness. And that weakness was probably amplified by a specific filing that caught people's attention. The CEO and founder, Sean Nelson, filed a Form 4. It reported the sale, the disposal of about 10,000 shares of Love stock.
Ooh, insider selling. Especially by the founder and CEO. That never looks great, does it?
It rarely does, though. There's important nuance here. The sale could be part of a prearranged 10b5-1 trading plan. These plans let insiders schedule future stock sales at set times or prices. It's done way in advance to avoid any suggestion they're trading on inside information. It's a legal safeguard.
But even if it's pre-planned and perfectly legal, how does the market perceive it, especially when the stock's already lagging?
Perception often trumps legality in the short term. Even if it's a 10b5-1 plan, The market sees the CEO choosing to sell shares now. It can be interpreted as maybe a lack of strong conviction in the stock's near-term upside, or just prioritizing personal diversification over holding every share. When the stock is already weak compared to the market, a filing like that just adds to the negative sentiment. It prompts questions, even if potentially unfair ones, about what management really thinks.
Understood. That's a subtle but important factor. Okay, let's move to our next sector, media and streaming. And here, the big theme seems to be the quality of growth, or lack thereof.
Absolutely. And FuboTV, FUBO, is a perfect example. It really highlights that earnings paradox we touched on earlier with Upstart.
Right. The numbers just don't seem to add up with the stock reaction. Fubo reported Q3 earnings. They beat expectations on both EPS and revenues. Sounds good, right? Yet the stock plummeted, down 11.9% on November 4th. Why would the market react so negatively to what looks like a positive report?
This is one of those times the market sends a very clear message. We see your headline numbers, maybe you cut costs effectively, but we're looking deeper, and we don't like the health of your core growth engines. Analysts immediately pointed to two major operational red flags that completely overshadowed the financial beat.
And those flags hit right at the core of any streaming business. Ads and subscribers.
Exactly. First, advertising revenue actually declined 7% year over year. For a service like Fubo, which relies heavily on ads to help offset the massive and rising costs of content, especially live sports rights, a decline in ad revenue is a huge warning sign. It could signal broader economic pressure on ad budgets, sure, but it could also signal that Fubo specifically is struggling to compete effectively for those ad dollars against bigger players.
If ad revenue is going backwards, their path to ever becoming profitable gets much, much harder.
Absolutely. That was concern number one. Concern number two was the international subscriber count. It dropped 9.5% year over year. That really hurts the growth narrative. The idea that Fubo could offset maybe slowing U.S. growth by expanding rapidly into new international markets, this number suggests that's not happening easily. Maybe it's even reversing.
So putting it together, the market looked past the headline beat, saw weakness in the fundamental pillars, advertising and international growth, and punished the stock severely. It's about the quality and sustainability of the business, not just hitting a quarterly number.
That's precisely the lesson from Fubo's reaction. The fear that the core engines are sputtering created too much perceived risk looking forward. Headline beat didn't matter.
Okay. Now, quickly on the giants, Netflix and Disney. Here, the news wasn't so much operational, but more about institutional moves and insider signals.
Correct. For Netflix, nflx, there was a Form 144 filed on November 4th. A Form 144 basically signals that a company insider intends to sell shares in the near future. It's a notice of potential sale. It doesn't mean the sale has happened yet, or even that it definitely will, but it tells the market someone close to the company might think the current price is a decent level to take some money off the table. Even a small signal like that can inject a bit of caution.
And for Disney, there was news about an institutional investor reducing their stake.
Yeah, based on a recent 13F filing, which shows institutional holdings from the previous quarter, news broke that an investor named Bernie Co. had cut its Disney holdings by a pretty substantial 40.1% back during Q2 of 2025. Now, 13Fs are backward-looking, right? This reflects a decision made months ago. But when news like that hits the tape, highlighting a big cut by an institution, it can still weigh on current sentiment and makes people wonder, what did Bernie see back in Q2 that made them sell off almost half their position? Did they lose faith in the turnaround? Were they rotating out of media? It raises questions.
Got it. And operationally, just a minor note for Disney. Confirmation that YouTube TV made a proposal to get Disney channels like ABC and ESPN back related to one of those carriage disputes.
Right. Standard operational stuff, keeping distribution intact. But really, all eyes for Disney are now firmly on their upcoming fiscal Q4 earnings report. That's due November 13th. That's where the market wants answers on streaming profitability, parks performance, the whole strategic direction under Iger.
Okay. Before we synthesize all this, we absolutely need to touch on the insurance sector, which saw some real volatility, and look at the key earnings hitting today.
Yes, the insurance space is definitely feeling pressure. Progressive, PGR, really kicked things off with a thud. They reported Q3 results late on November 4th. The stock reacted immediately in after-hours trading, dropping about 7.7%. It was a hard miss.
How bad was the miss?
Pretty significant. EPS came in at $4.45. Analysts were expecting $5.05, so a big miss there. And revenue was also a disappointment. $21.38 billion versus estimates of $21.8 billion. A miss on both the top and bottom lines.
Ouch. When you see a major insurer like Progressive miss that badly, what are the likely culprits? What's pressuring the sector so much right now?
It's usually a combination of factors, and they're severe right now. First, claims severity. The cost to repair or replace things, cars, homes, it's still very high due to inflation in parts, labor, materials. Second, catastrophe losses. Think hurricanes, wildfires, major storms. We've had periods of higher than expected cat losses that push claim payouts way up. And third, the cost of reinsurance. That's the insurance that insurance companies themselves buy to protect against huge losses. That market has hardened dramatically, meaning reinsurance is much more expensive. Progressive's miss suggests that even with the rate hikes they've been pushing through on customers, it's still not enough to keep pace with these rapidly rising costs on the back end.
And that miss from Progressive sets a really nervous backdrop for today, November 5th, because Allstate, ALL, is scheduled to report its Q3 earnings today.
Exactly. All market attention in the insurance space is laser-focused on Allstate right now. Their report will be seen as either confirming the negative trend Progressive highlighted or maybe showing some resilience. Investors will be tearing through Allstate's numbers, looking at underwriting margins, their exposure to recent catastrophes, and crucially, any comments management makes about pricing versus claims costs. The result could really set the tone for the whole P&C insurance sector short term.
Okay, besides insurance, a couple of other key earnings today. Duolingo, DUOL, reports Q3 after the market closes.
Right. Duolingo's been a consistent performer, kind of a darling in the edtech space. They keep beating expectations, growing subscribers for language learning, now literacy too. Investors will be looking for that streak to continue, strong user growth, proof that their monetization strategies like family plans, the Super Duolingo tier are still working well. Expectations are generally high for another beat.
And before the market opens today, we get results from InMode, INMD, the aesthetic medical device company.
Yeah, InMode is interesting. Investors will be watching closely to see if they confirm the preliminary Q3 revenue guidance they already put out, which was $92.5 million to $93 million. Maybe even more importantly, can they maintain their full-year guidance? Aesthetic devices can be sensitive to consumer discretionary spending. Any hint of softness there, any lowering of the annual outlook could hit the stock hard. So guidance confirmation is key.
Got it. And one last quick note, Carvana, CVNA, not earnings, but they announced a multi-year marketing partnership with Stanford Athletics on November 4th.
Right. That feels like a signal. Carvana went through that intense period of restructuring, cost-cutting, just trying to survive. Launching a big, visible partnership like this suggests they feel they've turned a corner and are shifting resources back towards growth, brand building, customer acquisition. It's a sign they're ready to compete for volume again.
Okay, wow, we have covered a lot of ground. From really contradictory lending data at Upstart, aggressive pricing in health tech, that huge outperformance by Compass in real estate, a streamer getting punished despite a beat. What really strikes me is how selective the market is being. Just hitting a number isn't enough. It's digging much deeper.
Absolutely. And if you try to weave all these threads together from just this, concentrated 24-hour snapshot, maybe 3 key takeaways really emerge for you. First, strategic focus seems to be rewarded, or at least understood. Look at LifeMD, selling off a non-core asset to get cash and simplify. That's focus. Look at Hims&Hers, slashing prices, investing heavily in GLP-1s. That's hyper-focus on what they see as the biggest growth engine, even if it hurts margins now. The market seems to get why they're doing it. Second takeaway, market disconnect is real, and it centers on the quality of earnings and growth. Upstart's confusing EPS, Fubo's drop despite a beat. These show investors are looking past the headline numbers, weak forward guidance like Upstart's, or deteriorating core metrics like Fubo's ad revenue and international subs. That overrides any short-term beat achieved through, say, cost cuts. Quality matters more right now. And third, the real estate narrative is clearly split. You've got Compass, the tech-enabled broker, growing transactions at 10x the market rate, leveraging tech and agent recruitment. But then you have the luxury end, like RH, facing questions about the timing of big investments, and specialty players like Lovesac dealing with insider sale optics and macro pressure. It's not one monolithic story.
That's a great synthesis. So thinking about what's happening right now, especially LFMD's divestment and Hims' really aggressive GLP-1 pricing, here's a final thought to leave you with. How far can these virtual health companies push these strategies? Aggressive pricing cuts, selling off parts of the business. At what point does it start to maybe cannibalize long-term profitability? Or, maybe even more critically for Hims, alienate the compounding pharmacies they rely on? That's something to really chew on as these next earnings reports land.
That's a critical question. Finding that balance between aggressive growth and sustainable, profitable operations in this virtual care boom, that's the challenge ahead.
Absolutely. Well, thank you for letting us guide you through this deep dive into the latest market moves.